Will the Fed be able to tame America's housing bubble? Places in the US that used to be relatively affordable are now some of America's most hottest housing markets. Places like Punta Gorda, Florida and Ocala, Florida have home prices that are up 34% year over year. Places like Ogden, Utah and Lakeland, Florida also up another 30%. And you may have not ever even heard of some of these places, but yet they are now literally the hottest housing markets in the US in terms of how much appreciation they've seen in the past year. The work from home movement and the availability to work remotely has definitely changed the entire dynamic of our country and where people are deciding to live and work. The problem is places that used to be considered affordable are now becoming extremely expensive relative to what people make in those areas. So the question going forward is, can the Fed tame America's housing bubble? Literally today is Wednesday, May 4th, and they are meeting as I'm filming this video to raise their interest rates by another 0.5 percentage point, and they plan to do the same exact thing going forward into June and July, raising the interest rates by another 0.5 percentage point. But is it going to be enough? A lot of people think, including myself, that they should have taken more drastic measures by now. It's already May. We're almost halfway through the year already. They've only raised the interest rates once by 0.25 point. A lot of the mortgage interest rates have gone up significantly in anticipation of that and just by them announcing it. But now that they're going to be doing some more serious hikes, where are the interest rates going to go from here? We're already seeing that demand for adjustable rate mortgages have literally doubled in the last 90 days, as now these rates for adjustable rate mortgages have been lower than 30-year fixed rates. Most likely because inflation is extremely out of control and these lenders are going to be losing money. Not only that, but with an adjustable rate mortgage and these rates continuing to rise, there's a really high chance that lower adjustable rate mortgage people are getting right now will be higher in a year from now. And they have the right to raise those interest rates, and that's exactly what they're probably going to do. So they're basically giving the bait for someone to take a lower interest rate right now that looks attractive, and that person is betting on the fact that they'll be able to refinance down the road, hopefully to a lower rate. But with these 0.5 point interest rate hikes coming from the Fed and then 0.25 point rate hikes after that, there is a very low chance that interest rates are going to be lower in a year from now. If anything, they'll be considerably higher. So if you're one of those people taking out one of these adjustable rate mortgages because it looks good right now, you need to be careful. A recent survey from Bank of America even shows the desperate lengths that homebuyers are going to now in order to buy a house. People are taking on second jobs and side hustles in order to make more money, in order to even afford a home. With these higher prices and higher interest rates, they're also sacrificing on the location of the home, moving further away from local amenities such as stores and restaurants, buying in up-and-coming neighborhoods, and also buying a smaller home with less outdoor space, all just to get in. And on top of that, people are opting to take more of these adjustable rate mortgages. To me, as a real estate agent, this all sounds like disaster. With interest rates pretty much primed to go up in the next year with all these federal rate hikes coming, those adjustable rate mortgages will price people out of their homes. And if they have to take second jobs right now just to be able to afford something like that, then what happens if they lose that second job and these rate hikes push us into a recession? Then a lot of those people will not be able to make their mortgage payment. But right now, the Fed is trying to play a balancing act. They raise their interest rates basically month by month here going forward throughout the year, and simultaneously shrinking their balance sheet of treasury and mortgage bonds, which typically they would sell off about 50 billion worth per month, and now they're going to be on track to sell off 95 billion per month in hopes to try and fast track our economy getting back to a more balanced market. However, because they're basically pulling two levers at once, the results of this is basically unknown, and that's why in one of my previous videos, Fannie Mae was calling for there to be a recession by the end of 2023. But We already had our first quarter of negative GDP growth here in 2022, and all we need is one more during this summer, and then we will already be in a recession by the middle of this year. However, they don't want that to happen, but they're pretty much left with no choice. They simply almost need to cause a recession in order to tame this housing market bubble, because it's really going to be the only thing that's going to be able to help. Because we have this unique situation where supply is so much lower than demand, lower than it's ever been, it seems like, in recent history. So the only way to lower demand is to basically make homes so expensive by having these interest rates so high that most people won't even be able to buy anymore. And that's where I see things going in the next few months. This is also going to have other consequences that could potentially throw our economy into recession, because if the interest rates get too high, then companies can start closing their doors. The stock market has already been going down since the beginning of the year, and that trend can continue to get worse, and basically things start snowballing from there. People start pulling money out of the stock market when things start getting worse, looking for alternative investments, which makes the stock market go down even further. And the more the stock market goes down, the higher chance that some of those companies will start doing layoffs. People will start losing their jobs. And once again, we have the perfect storm of less people being able to afford a home because interest rates are super high. People are starting to lose their jobs, which makes them less likely to be able to afford their mortgage payment, leading to more foreclosures and short sales coming within the next 18 months. And an economist from Deutsche Bank even said that the balance sheet reduction by the Fed would actually translate into them increasing their interest rates by 4 percentage points through 2023 when combined with their actual rate hikes, as it will have a similar effect on the market. So imagine if the federal rate is up 4 percentage points when we were literally hovering around 0.25 to 0.5% for the longest time during the pandemic. Where do you think that's going to take interest rates? Right now, for a 30-year fix, you're already looking at 5.5% to 6% in a lot of cases, sometimes even more if your credit's not as good. And then imagine a year from now where that could be. We could easily be in the 8s, 9s, who knows? So one thing that's definitely unclear right now is if these interest rate hikes are going to be too little too late, if it's really going to have a big enough impact. I personally think that they will have an impact, especially if it affects mortgage interest rates and the cost of borrowing for other things like car loans, for example. So I do think it's going to have an impact. But my concern is that they're just not doing it fast enough. Meanwhile, inflation is running out of control. And if it gets too far out of control, then literally everyday items that people used to be able to buy and need to buy can become unaffordable, along with housing as well. And that's literally the last thing we need in this country right now. So I know nobody ever wants to have a recession, but in this case, we pretty much need to have a recession, guys. That's the unfortunate truth. I think it's the only way that our country is going to bounce back from this and sort of get back to normal. I think the Fed needs to start raising interest rates by more percentage points and faster in order to get things on track faster. Because literally 70% of housing markets in the US have seen double-digit appreciation just in the last year. And like I mentioned at the beginning of this video, a lot of these places are relatively unknown areas of the country that previously were considered to be affordable by the everyday man, and they no longer are. And we just simply cannot continue to go in this direction, because if places that were once considered affordable are no longer affordable, that's going to present a huge problem for our entire economy and population as a whole going forward. And Fannie Mae, a government agency, has literally already said to get ready for a recession because they believe it's coming. And if you want to hear more about that, then check it out in this video right over here, and I'll catch you guys over there.